The views in this podcast are those of the contributors and don't necessarily represent those of CISL, the University of Cambridge or Investec, and should not be taken as advice or a recommendation. Welcome to What Next? Leadership Conversations for a Better Future from the University of Cambridge Institute for Sustainability Leadership in partnership with Investec. This series is hosted by Lindsay Hooper and Mark Kahn.
Hello and welcome to What Next? Leadership Conversations for a Better Future, where we explore how leaders can help build future-fit economies. I'm Lindsay Hooper, Chief Executive at the University of Cambridge Institute for Sustainability Leadership.
And I'm Mark Kahn, Chief Strategy and Sustainability Officer at Investec. Together, we'll bring fresh perspectives, provocative questions, and conversations with leaders who are shaping the future of markets, business, and society.
Welcome to this episode. Today we're here to talk about finance, about how we unlock capital for activities that address global challenges such as climate change, nature loss and inequality. And we're meeting at a moment when we know that many sustainable finance initiatives have stalled just when acceleration is needed. So the question is, where do we go now? At CISL, our view is that approaches that are grounded only in moral intent and not in market design won't scale, and finance will only move at pace when the rules, the incentives and the mindsets that govern it are rewired and when capital is connected to investable real-world activities. This conversation isn't about dissecting what went wrong with what I call the ESG hype bubble, but about learning from it, really exploring what role finance can realistically play in driving cleaner, greener, fairer economies. Importantly, where the biggest opportunities lie and what kind of leadership will get us there. And we're joined today by three people who've got really deep perspective on these questions. Jose Viñals, who until recently was Group Chairman of Standard Chartered, a bank with deep roots across emerging markets, which gives them a really distinctive perspective on how global finance can support growth, stability and transition in the parts of the world where investment is most urgently needed. We're also joined by Sarah Kemet, who spent a decade as a financial regulator before leading the UN Net Zero Banking Alliance, which is now drawn to a close, but whose work will evolve in other ways. And as someone who's been directly involved in building a really ambitious global effort to align banking with net zero, she's got deep insight into lessons learned. And last but not least, my colleague in Cambridge, Dr. Nina Seeger, who heads the Centre for Sustainable Finance, which works with public and private financial institutions to help restructure the financial system for a sustainable economy, connecting capital to innovation and contributing to investable transition plans. Welcome.
Jose, Nina and Sarah, thank you so much. It's really a privilege to have you here. I'd like to really begin by opening up the possibility for you to share personally what the journey was that put you in the intersection between sustainability and finance. And maybe if we can start with you, Nina.
I'm delighted to be here. We are recording this podcast in the centre of the City of London, at its heart. And actually in this very building, I spent many years working in risk on the trading floor. And post the financial crisis, I was really interested in resilience of the financial system and the sustainability of the financial system. And that's what brought me to Cambridge. And ultimately, a lot of the work that I do right now is born here.
Thank you very much, and it's great being here. Two things. I think that when one talks about sustainability, one talks about present and the future of the world and the billions of people who live here. And in my case, the intersection between finance and sustainability and other global challenges come from my hybrid nature professionally. As an international public servant until 9 years ago when I became chairman of Standard Chartered. So I have seen it happening from both points of view. And given that finance can play such a fundamental role in fostering sustained growth and sustained development, I think it's very natural to combine both things. And I've been very privileged to have done so during my nearly 10 years at the IMF and then nearly 10 years at Standard Chartered.
I spent 10 years as a soil scientist, And then after the financial crisis, I had an opportunity to move into financial regulation. At the Bank of England, I worked a bit on climate risk and then moved to UNEP-FI, where I was able to move more into working on climate impact. The thread through all of that is being interested in systemic change.
All right, so let's move right into the heart of things right now. The FT used the idea of the end of the ESG party. That's where we are. There's clearly been a backlash, or at the very least, pushback on ESG as a methodology to direct capital into positive ways. How do you think about this now? I mean, is ESG something that we still will find valuable going forward? Where did we get it wrong? Did we get it right and some things needs to be reconsidered? What is your view on this?
I think that when there is a problem with something, the first thing is to understand what led to the problem. Perhaps for many people, they have lived a bit into a ESG bubble without recognizing some things that needed to be improved in that framework. And then there was a reaction to that. But I think that the idea of sustainability still stands very powerfully. This is something from the point of view of private companies that will be worth pursuing as long as it's a source of opportunity, as long as it's aligned to their commercial strategy. Of course, companies need to align profit with purpose. But of course, given that companies have fiduciary responsibilities to the shareholders and to all other stakeholders, need to make sure that sustainability, in my view, remains integral to the strategy of the company, but fully aligned with its commercial objectives. Now, I think that there has been a political reaction. I would distinguish between what's happening in the United States and in the rest of the world. If you look at the European Union and at the universe of emerging markets and developing countries, it's a very different situation from what's the case in the United States. In the United States, there's been a political campaign against sustainability, ESG, and we know what have been the consequences of that. But if you look at the UK, if you look at the European Union, from the point of view of policymakers, there hasn't been a significant shift. They continue thinking that sustainability is extremely important. And if you look at most of the companies in these two, UK and the European Union, again, they remain aligned and convinced that sustainability is important to take into account when they take their commercial decisions. And of course, emerging markets and developing economies are the ones that, for example, on the climate change front and many social issues, they are really at the receiving front. They face the problems more acutely than anybody else. So they're deeply aware and conscious of what the problems are, and they really know that they have to remedy that. So I think that sustainability remains a huge opportunity from the commercial point of view, from private companies. In the case of organizations like Standard Chartered, for example, it is key to our strategy.
If I pick up a point there that you've raised, which is, of course, where the criticism has been leveled, which is that capital doesn't just follow for good, it follows for commercial return. Perhaps, Nina, I can ask you that. Is it fair to say that we got that a little bit wrong? Certainly on the ESG front, that it can't necessarily be true that doing good for the world through some kind of enterprise is always a commercial positive.
I think there are two questions in there in what you're asking. I think question number one is, how do we connect doing good with creating profit? Right? And the second question is, do we expect finance to reform the economy? I think there's been a lot of assumptions about the role of finance in that game. And I think some of the assumptions have been that we're going to use the financial system as a way to change the underlying economic system. And to a point, there are levers within finance that could be used to that effect. However, if it's not coming together with a viable industrial strategy into which finance is able to lend, into which finance is able to invest, it's really hard for financial institutions to be pushing that vector. But It's an interesting question, right? Because people look at the ESG party and go, oh, it's over. Now what do we do? And what have we spent 10 years doing? If you look over the last 10 years, the decade pre-Paris, emissions have grown by 18%. The decade post-Paris, emissions have grown by 1%. Those are fundamentally different numbers. Up to 2023, we have mobilized $1 trillion in climate finance. It's a massive number. However, most of that money has been mobilized domestically. 65% of that is China. So we do need to recognize progress that was made during the swing, but also recognize how do we need to rewire and reform the financial system and the economic system that it is driving money into it in order to continue moving at pace, arguably to move a lot quicker.
Very, very interesting. Sarah, if I can bring you in here. Now, you really led the Net Zero Banking Alliance initiative along with your colleagues, and we've seen that it has fundamentally changed its nature due to pushback. When we look at the rhetoric in the world today, the mechanism of net zero, or the construct of achieving net zero as the sort of grand ultimate goal for capital to put all its muscles into achieving, seems to be a less and less adopted, attractive to people. What is your take on that from where you have sat? Because you've certainly been in the roller coaster yourself.
I would say that there is still huge validity and importance about pursuing a net zero goal. Net zero is a condition that we need to achieve if we are going to stabilise the climate. I think that where we've got to with the politicisation of the term net zero, there are big headwinds. There are political and ideological shifts. There's been a lot of disappointment from civil society. And I would say we've got politically shifting priorities. We've had higher interest rates, cost of living crises. We've had energy security issues, etc. So, yeah, it's still a very valid goal. But we just need to find better ways to articulate it and better ways to overcome the barriers to achieving it.
Broadly speaking, people working in our space are not necessarily arguing with the science, but big questions whether in light of those headwinds, foregrounding net zero serves as well, or is there a question about whether we let go of it as a visible headline, the visible goal? Given this is such a live debate at the point when we're recording this about whether net zero helps or harms in the way we talk about the need for action.
I think people are arguing with science, just to dispute a tiny thing that you said, and people are pushing back against the idea. And I think that's part of the issue that we're facing, that climate denial is in the mainstream. I think that's a recognized fact. And there are a variety of reasons for that. But I think recognizing that we are where we are, we need to think about the way we transition. We need to change the way we talk about it. And I think we're consistently not using all of the tools at our arsenal to be solving the climate issue while solving the cost of living crisis and while looking at the issues that are faced day to day by people. And I think a lot of the pushback in the US is actually deeply rooted in the social. It's deeply rooted in the fact that people don't see their place in this new world. And yet we're also not recognizing that right now, the number of renewable energy jobs in the world is the same as the number of fossil fuel jobs. Like, we are already living in a fundamentally different universe. And coming back to your original question, should we let go of the net zero or should we not let go of the net zero? I don't really mind what we call it, as long as the underlying work to continue moving the transition goes.
Net zero remains a very important principle, both for governments and for businesses. And in terms of capital allocation, how do you make sure that capital goes to the destinations which may be at the same time commercially profitable, but at the same time in line with broad policy goals? Well, you need to align policy tools in order to provide the right incentive structure. We know that mice go where the cheese is. Okay, let's make sure that policymakers put the cheese in the right place. So that's number one. if we don't dispute the world is under challenge and that net zero remains important, I think that this remains very useful for both designing public policy frameworks and for businesses. I think it's very important that businesses which think of sustainability as something integral to their strategy and which is fully aligned with commercial opportunity continue focusing on net zero. In the case of Standard Chartered, as a particular example, we publish our net zero plan slightly ahead of Glasgow, already quite a few years ago. And we have found this and continue to find this extremely important in communicating with our corporate clients, with our private banking clients, with our regulators, with our shareholders and investors. This is something that we find is very important. And it's also something which has helped us put some business targets which we think are very useful in terms of enhancing our profitability. For example, committing to mobilizing $300 billion of sustainable finance in the current decade, of which this is being delivered at pace in our case of about $30 billion a year. And then having some objectives regarding revenues coming from sustainable finance, which we're also hitting.
Are we not glossing over the real reason why the concept of net zero and where, the Net Zero Banking Alliance has found itself really comes from? When I put the cynic hat on, doesn't it come from the idea that pursuing a decarbonization agenda for the world economy is not economical and not commercially viable and will be bad for the economies of certain states and certainly not good for certain big companies? And the pushback on net zero is not a science pushback, but it's actually a statement of financial viability. And if I was to sort of put it in a meme, it goes like this. ESG, net zero, sustainability, yeah, sure, it's all good stuff, but it's just not commercial. It's just not financially viable. And so pursuing that is against the interests of shareholders and not in the interests of pursuing the right levels of profitability and competitiveness in various enterprises. Isn't that the real pushback?
Oh, I can go on this for a long time. Okay, so let's disentangle slightly. There is a difference between climate risk, economic risk, and financial risk. And the massive difference is climate risk does not care what kind of, what we think about it, right? It's a physics, it's chemistry, what Sarah was talking about, right? Economic and financial risk, the models which we use to calculate those, have been created in this city, also in New York, in most of the financial centers. We write the models with which we calculate both the financial risk and the financial profitability of any deal that we do. We assume particular cash flows when we write discounted cash flow models, don't we? Right? So when we do not price climate, nature into those models, it is entirely up to us to change those models so that they actually reflect the reality. So I think a lot of the root of the problem that we currently have is we are underestimating to quite a huge part the amount of risk that we're sitting on. And it's not only systemic risk that we're sitting on. We have financial institutions, we have corporates that are sitting on quite idiosyncratic risks in their own portfolios, not in somebody else's portfolios, in their own portfolios. And because those risks are not priced according to the effect that they're going to have, they're essentially sitting there at zero. And therefore, doing brown business is more profitable than doing green business. So we do need to adjust those calculations in order so that doing the right thing becomes the financially viable thing to be doing. I mean, if you look at right now, most financial institutions assume that physical risks will be covered by insurance, right? Most insurance companies in the same way assumes that they can trade out in 12 months out of most insurance contracts. There is a fundamental difference in the assumptions that are held by financial institutions across the portfolio. So I think it's not the fact that doing work on building resilience to climate or building up NBS is fundamentally unprofitable. because we see lots of opportunities in that space. But it's not really showing up in the core models that are day-to-day used by financial risk managers, by traders, by bank client relationship managers.
Why is that? The finance sector is brilliant. Pricing risk is really what it does. So why is this not happening? If you're saying it's just the models don't work, we haven't got the right models, and yet the scale of the systemic risks are huge. We sit and just see a mountain of evidence about the macroeconomic risks. Why is the motivation not there? Why is it not happening that financial institutions are joining the dots and pricing it in? To come to you, Jose, from a bank perspective, what's really getting in the way?
There are many barriers which have nothing to do with the conviction that taking the world to a more sustainable position, both in terms of climate and society, is good. It still can be good, but there may be barriers which prevent finance moving in that direction. So conviction is one thing, and the other thing may be roadblocks that need to be addressed. If you look at the situation of emerging markets and developing economies, which are mostly affected by the impact of climate change, you can see devastation. There are things which have tremendously destructive impact on the economy. And that's something that needs to be addressed. Of course, you cannot unplug economies which are nowadays based on conventional source of energy and move overnight to renewables. You have to have a transition. And you have to have a transition that makes sense. And you need to decarbonize those economies. In some cases, the first thing you need to do is to close coal-fired power plants, like, for example, what the G20 is trying to do in Indonesia with the help of GFANs, by the way. You need to transition from coal to gas, which may be useful in the transition, and then ultimately to renewables. There are other countries which may go very quickly, like in Kenya, because they have the conditions to jump immediately into renewables. So the situation is very difficult. So I think it's a question of how you manage the transition. But ultimately, business decisions and policy decisions which foster alignment with sustainability on the climate side and societal side allow for avoiding this sort of distraction coming from climate change, avoiding the deep social problems that come from societies which become very poor as a result of that, which at the end may want to go for political solutions, which may be even worse. So there are very good reasons for moving in that direction. I can provide an example in terms of the sustainable finance revenues. The sustainable finance rate of return is equal or better than the average from all of our investments. So again, we see an incentive for moving forward in that space.
Yeah, maybe I can just underscore a little bit what Nina was saying about the risks being underpriced in. We have a lot of evidence, I think it's quite indisputable, that the costs of inaction are far higher than the costs of action. And that's something that we're not really communicating about enough. But the issue is that the costs and benefits of action versus inaction fall on different people at different times in different places. And the markets are not correcting for that because 28% of global emissions are under some kind of carbon pricing, but obviously the majority of emissions are not priced. The negative externality of those emissions are not priced. And while banks can be very highly diversified, so a climate event in one place may not pose any real risk to them because it's a small contained event like a flooding or a storm. I think what we need to really think about in the scenario analysis that we're doing is how those risks will layer one on top of the other. So it's not just, there's a storm here or flooding there. It's actually, maybe we've got a cost of living crisis and maybe there's a lot of inflation caused by increased food prices because of the physical effects of climate change. Maybe there's a lot of migration. Maybe insurance coverage is not so certain. Maybe there's a lot of water stress or really high health costs because of the effects of climate change. And when these things layer on top of each other, that's when we're really going to start to see the exacerbation of all of these geopolitical risks that we're talking about now, but also those systemic risks which come back and impact firms and their portfolios. I think also tipping points, very plausible outcomes, big shifts in the Earth climate system are not really being factored in to this scenario analysis properly. So we definitely need governments to be stepping up to kind of bridge this gap that we're seeing here.
We are focusing a lot on climate. And when I think of sustainability and sustainable development, I think it's a broader conversation. And for that, you need sustainable infrastructures. And this is an area where, contrary to what may be happening in climate, where the private sector may be underestimating some of the risk, some financial institutions more than others, let me say. When you look at sustainable infrastructures, it may be that it is the public sector which is overestimating the risks. And I'll give an example. Financial regulation applies sort of capital requirements for infrastructure projects in emerging markets, which I think vastly overestimate the true risk associated with these projects. And this is something that can be demonstrated on the basis of the micro experience of a number of financial institutions.
I suppose what I'm hearing is that really the best way to manage the risk is to build something better, to actually make the transition investable, to build the infrastructure or the industries or the technologies that design the problem out, rather than, I think a lot of the conversation has just been about restraint or stopping what we do. And we need to be much more focused on what needs to be built. And I loved your framing earlier, Jose, like the mouse will follow the cheese. So you've already started to give some examples, but how big is the cheese really? And where is it? Does the opportunity really exist? And where is that? What's the scale of it? And what does it look like?
If I look sectorally, I'd be looking at things that are just outside of the renewable space. Because I think renewables are mostly financial and doable within that space. I think the more interesting opportunities sit in infrastructure, in grids, in resilience, in water, in agri-food systems, combating waste in agri-food systems, also a massive issue. I think the point Jose was making about emerging markets and developing economies is very, very valid, because a lot of the opportunities sit within that space. If you look at infrastructure defaults in Africa, their rate of default is a third of that of a rate of infrastructure defaults in the United States of America. And yet we price that risk completely differently. And obviously some things here is about, who finances and whether MDB money has gone to de-risk and all of those wonderful things. But I think moving money where it needs to go is A, important, and B, is a source of huge opportunity. And I think regionally, and again, we spoke a little bit about how we're going away from a pure play global picture to a very regionally specific picture. I think regionally, those opportunities sit in Africa and in Asia, which has seen probably the highest rate of growth in sustainable finance.
The opportunity is massive. Certainly Asia has a lot of it. Southeast Asia and South Asia need a lot of financing for sustainable infrastructures which go beyond energy. Energy is an important part of it, the energy transition. If you look at the ASEAN region in Southeast Asia, what you see is that there are now important plans to have connectivity and to have a regional market for electricity, which now doesn't exist. That's very important. You can think of data centers, of many things which are being done, for example, in the case of the Gulf Cooperation countries for diversifying their economy. These are countries which have, in addition to a lot of oil, a lot of sun. So they are very important projects which are being done there. Infrastructures in terms of water safety, or water where you have returns in terms of GDP, which are $12 to the dollar invested. Sometimes the key is how do you monetize the return, because that return flows socially. But again, this is where we come back to the issue of partnership between the private sector and the public sector to make sure that there are structures which have a risk-return equation which lets the money flow, incentivizes money to flow to the right destinations. In those cases where that's needed, there are other times when private money will flow automatically. You don't need anything, right? And there are other times when you need the role and the support of this multilateral or regional development bank or other de-risking schemes to make sure that you have the right structures which are appealing to the type of investors. But the opportunity is huge throughout Africa, the Middle East, Asia, and Latin America.
I'm going to be a devil's advocate. This concept of the massive opportunity. Some people would say, if the opportunity is so massive, then capital will naturally flow there. We don't need sustainable finance frameworks for banks with targets, because if the opportunity is so huge, the natural activity of the economy and the advantage of getting capital into those right enterprise plays will happen in the normal course. If we look at the targets across banks for sustainable finance and we add them all up, they still form a very small percentage of book. So how can it be that the opportunity is so massive, and yet even when there's a deliberate targeting of sustainable and transition finance capital, it's still such a small percentage of book?
Right. So I think that one needs to distinguish two things. One is the opportunity, but then one needs to look also at what are the barriers in materializing that opportunity. And the other thing is that the opportunity may be there, but it is an opportunity that for the time being, it's been realized in terms of individual projects here and there in a very ad hoc manner. And in order to be able to get, for example, asset managers and other institutional investors interested in these things, what you have to do is, for example, really move to a concept of infrastructure as an asset class and to have products which are interesting for these institutional investors because they're fully consistent with their regulatory and fiduciary responsibilities and attractive in terms of return. I'll give you an example. When the World Bank was trying to persuade investors to co-invest in certain projects, some key institutional investors said, we're not interested. But when the World Bank takes loans that they have made to emerging markets, they package those loans, diversifying across countries, across projects, risk gets diversified. When they structure those projects with certain guarantees so that there is a sort of senior tranche, which is investment grade, then they're able to place those packages in the market, and then institutional investors are very pleased to come in. So we really need to go from this project to project approach, which is normally done through blended finance and other type of mechanisms, in which take 2 or 3 years to realize, to something which is a portfolio of projects with good partnership between the private and the public sector, the right structured products which are palatable to institutional investors, because then it would be attractive and it can be scaled up. But until we do that, the opportunity will remain massive, but unaddressed.
We look at business as usual, we sometimes conveniently forget that business as usual still has a bunch of fossil fuel subsidies baked into that situation, right? If we took all of those fossil fuel subsidies away, then the financials of it might look slightly different to what they look like now.
Exactly. I was going to come in with fossil fuel subsidies. They're over $1 trillion a year directly. And if you incorporate indirect fossil fuel subsidies, I think the IMF has calculated it to be about $7 trillion a year. That, coupled with carbon emissions not being priced, really is a market distortion. And so, the issue isn't capital scarcity, it's the design of the system. And it's really overcoming these barriers. Now, a lot of this transition is bound to happen with time anyway. I think where we do need action is to really accelerate the transition. So to have initiatives that look at how to accelerate the transition in these very hard to abate sectors and really go out of their way to bring together the stakeholders to look at how do we de-risk this first of a kind plant, which is going to reduce the emissions of one of the hard to abate sectors. So there's a lot to do in terms of reforming markets, and the point about prudential regulation, pricing, having risk-weighted assets appropriately is really important for mobilising emerging markets finance. So taking into account where there's a guarantee or some concessional rates or those sorts of things. The market integrity and having sound disclosure frameworks is really important, and defining what's green and those taxonomies. Those are kind of fundamental building blocks that are going to help to really accelerate the transition, but also looking at various different elements of the infrastructure around planning, around permitting, around grid connections, digital grid modernisation, etc. So I think those are some of the things where we can bring different stakeholders together to really address some of these kind of systemic barriers.
When we look within the financial system, and you talked about pricing and models and so on, what would you be prioritising right now? Conversations often circle around blended finance, public-private collaboration. What should we be focusing on now that will actually unlock that accelerated transition?
So within the very core financial world, I'm looking at three things that I think are key. Number one is looking at core financial models and ensuring that those reflect reality as it is today, not as it was 20 years ago. Number two, standardizing the transactions. I think we currently have a lot of attention going to individual hero transactions that take 2, 3, 4, 5 years to develop a single transaction. We need to get this to stuff when it's deeply boring, but deeply standardizable, where it's easy to do, where the term sheets are there so that we can do many, many of these things. And the third one is this point around the financial architecture that allows us to move money into emerging markets. It's around having conversations with rating agencies about whether those credit ratings are adequate, and for those projects, whether the recovery rates that they're using are calibrated according to the history, because some of those loss histories are now becoming public. So there is a little bit of recalibration that can be made. Looking at new financial products like guarantee, so you're not using a lot of that balance sheet, but still enabling that rating lift. And just generally looking at things where there are blocks. I mean, just coming back on the infrastructure point, one of the things that's really interesting is that our capital regulation puts a higher premium on longer dated transactions, right? All of infrastructure is long dated by default. So looking at those blockers, which are really within our gift.
What are the practical things that are needed right now to address some of the roadblocks so we can realize that scale of opportunity?
In addition to all of these things, national policies are extremely important. You know, if you really are a country which is interested in moving forward in the sustainability dimension, you need to take certain action. We had the commentary on subsidies. There are other things like national transition plans, which is extremely important. And more broadly than that, you need to provide the conditions which make your country and investing in your country more attractive. This is valid for sustainable investment, but it's valid for investment in general. You know, basic things like the rule of law, the strength of your institutions, macroeconomic and financial and political stability, ease of doing business. All of this is extremely important. Sometimes you get great projects there, but if this macro uncertainty is there, people may not touch it. And then the issue that when you go to do financing for specific projects, you have to deal with the issue of licensing, of many administrative burdensome processes and many other things which may complicate uncertainty. So life is complicated as it is. I think that one should not add to this uncertainty through the sort of things that you were talking about. But I think that national economies still to do a number of things. And something which is extremely important, which has been highlighted by the IMF for many years, which is domestic resource mobilization. Part of the transition is going to be financed with international capital, but a lot of it is also going to be financed by domestic capital. But if you're raising tax revenues of 5 to 6% of GDP, that's very little. You have to go to higher numbers. The IMF was saying a couple of weeks ago at the annual meeting something like a minimum of 15% of fiscal revenues over GDP as a minimum for the public sector to be able to provide some of the incentives and spending and conditions for the domestic public sector to play a role as well. And the development of local capital markets, this is plain vanilla stuff. It's for sustainability, but it's for good economic growth and development regardless.
Really important. And I just want to pick up a potential tension here. Nina, you talked about some of the vanilla just kind of good business stuff. You did frame being deeply boring as an aspiration, but my perception from an outsider of the financial system is that institutions have somewhat of a herd mentality, that sentiment actually really matters, and that sentiment and confidence has been knocked. It's just not where the action is. The action is all around, say, AI or defense. And some of the devil's advocate perspectives that Mark is voicing is because that reflects where some of the real sentiment is. So I'm interested in how do we square this?
I'm talking about the structuring of financial transactions. So the easy stuff, not the kind of bells and whistles that takes us years to develop. At the same time, I think we do need to rebuild the narrative that works for every layer of society, where we talk about doing deeply boring stuff like retrofits because it will address our cost of living crisis, because it will make our homes warmer. So I think it's making it relevant to everyday problems of everyday people that will get the stuff going, and not necessarily winning on tagging climate or nature for all of this stuff.
I think that in emerging markets, this is something which may be better understood because the realities of lack of sustainability hit people's life directly. There, it may not just be the cost of living, it may be the cost of losing your life. But in advanced economies, I think that there is a need for a better narrative. Two things where I saw a lot of excitement about sustainability-related investment. One was the Finance for Development Conference in Seville at the end of June and beginning of July. We had a great participation of the business world with more than 1,000 business representatives. And they were saying, look, we're interested and we want to know how to best partner with the public sector in order to take forward these investment opportunities that we see. And mid-October, at the IMF World Bank meetings, a lot of the conversation was about AI and about all the tech-related, very, very cool things. But there was also a lot of conversation about sustainable infrastructures in emerging markets and developing economies as a very important area of opportunity. The world needs capital for all of these things. It's not just AI, it's all of the other things. And there are deep interactions between these things. And I'm sure AI, over time, is going to make some of these infrastructures much smarter and much more powerful. So there will be a joining of the forces. We are not there yet. And yes, tech now is getting biggest valuation increases and is in fashion. But these other things remain extremely important and can be very profitable.
One of the most important things that the public sector can do is to give policy certainty. So there is nothing that kills off investment more than lack of policy certainty. And I think we've seen in several industries some to and fro on different policies around decarbonisation. And I think that's a real problem. And the other thing that the public sector can do is to kind of lead by example in terms of the public procurement standards that they have. So governments, subnational governments, cities are huge procurers of goods and services. And if they make sure that they are buying the green cement or green steel for the projects that they're commissioning, that can really help to kind of stimulate demand and give more confidence. Another element in the transition is really around de-risking demand, especially where there are green alternatives, but there is some premium for the green product. So things like market pull coalitions and offtake agreements and buyers clubs, etc. I think those are the things that can really help to get a project over the line to final investment decision.
We've dealt a lot with the complexities of sustainable finance and banking inside of a market economy, which is not always aligned in the best possible way to the kind of sustainability outcomes that we so hope to achieve. So in such an environment looking forward, what would be the key leadership mindsets, attitudes, and orientations that we really need?
So number one, pricing risks on your book, having an internal carbon price, looking at actually what you're sitting on and considering when you're starting a new project, whether that project has the possibility to become a stranded asset or not. So realistic risk assessment lies at the core. Number two is investing in sustainability, investing in grids, in resilience, in all of the things that we've been talking about, preferably in emerging markets, and then being very loud when you're making money in that space, because it is demonstrating that some of the stuff is actually deeply financially profitable, that will help create a bit of a fear of missing out in this space. And then the third one is where you see issues, being vocal about it. Now, being realistic with the current market, sometimes that doesn't mean being vocal out in the FT about those issues, but it does mean having conversations behind closed doors with policymakers when they are considering particular policy proposals and pushing the point of policy certainty, pushing the point of policy ambition, and being quite clear about what kind of regulatory environment do you need in order to be financially profitable. So that's my three.
The first thing is you talk about risk. The opportunity is the other very important part of the equation. Number two, I think that private capital is extremely powerful in also leading to the right policy changes. And the G20, B20 agreement in Indonesia to have the JETP, the Just Energy Transition Partnership, where the private sector and the banking group agreed to provide $10 billion of capital, but the conditionality was that the governments will have to change the policy frameworks in such a way as to make those investments and other investments that may come afterwards more rewarding through better policies in a number of domains. I think that's a good way where the private sector can lead to change in public sector policies, which can in turn foster further private sector investment. So there may be a virtuous circle here.
And the third area, I think, is to really focus in on the just transition. So it needs to be fair. If it's not fair, it's not going to happen because people will push back and we will get more of the kickback. So it's really thinking about the fairness and involving communities and making sure that those considerations are brought in at every level.
Thank you all very much for joining us. I have to say it's very reassuring to hear a former bank chairman highlight the huge scale of opportunity, to be reassured that that exists. But I think we've also heard the need to be very realistic that financial institutions will need commercial returns. It's not realistic to expect them to engage otherwise. And in order to realise those, we've also heard there's a need for rewiring financial markets in various ways so those returns exist, can be monetized, can be realized, a need for state action to lay out the cheese so the mouse can see it and chase it. I love that framing. We spent some time on the very pragmatic focus on what today's real roadblocks are and had some great practical insights into what it will take to really identify what they are and move beyond them. And some of that, of course, requires action at national levels and policy certainty and standardization. Being relevant to social realities are all part of that mix. But I also really like this point about being loud when you're making money. I think being loud and unashamed about the money that is to be made through financing transition is going to be really important. So I'm going to close on that and thank you very much for joining us. Join us next time for What Next? Leadership Conversations for a Better Future.
This show is presented by Lindsay Hooper, Chief Executive of CISL, and Mark Calm, Investec's Chief Strategy and Sustainability Officer. The producers are Carl Homer of Cambridge TV and Alexa Selwood. The executive producer is Gillian Secret, and it's produced in partnership with Investec. Thank you for listening. For more episodes, subscribe on any major podcast platform or visit the Leadership Hub on the CISL website or Investec Focus. You'll find the address in the show notes.